This was one of those weeks where the stock market looked pretty strong on the surface, but underneath, investors were dealing with a much more complicated setup, because the big question was this: are we still in a bull market powered by AI, strong earnings, and mega-cap tech, or are inflation, oil prices, and higher interest rates starting to become a real problem again? And honestly, the answer this week was kind of both. So today, I want to walk through what actually happened from May 18th to May 24th, why stocks were bouncing around, why Nvidia once again became the center of gravity for the entire AI trade, and what I think investors should really be watching next. And if you enjoy these weekly market recaps, make sure to like the video, comment your thoughts below, and subscribe for more stock market and investing breakdowns. Let's start with the big picture. Early in the week, investors were nervous. Oil prices were rising, bond yields were moving higher, and that combination immediately brought back one of the market's least favorite phrases: higher for longer. Because when oil goes up, investors start worrying about inflation, and when bond yields go up, stock valuations come under pressure, especially for growth stocks. That is why the Nasdaq struggled earlier in the week. Higher yields are especially painful for high-growth companies because a lot of their value depends on profits expected far into the future. When rates rise, those future profits become less valuable today. But then the mood shifted. Oil cooled off a bit, Treasury yield pressure eased, and investors moved back into growth and AI-related stocks. By Friday, the market looked much better. SPY was up 0.37%, QQQ was up 0.42%, DIA was up 0.59%, and IWM, which tracks small caps, was up 0.93%. Small caps outperforming usually tells you risk appetite is improving. But I would be careful not to overread one good day. Small caps are still very sensitive to higher borrowing costs, so if yields stay elevated, that part of the market can run into trouble again pretty quickly. So yes, the week ended on a more risk-on tone, but it was not a clean, everything is great type of week. It was more like the market saying AI is still strong enough to carry the bull case, but inflation and rates are still hanging around in the background. And that brings us to the biggest corporate story of the week, Nvidia. Nvidia reported record revenue of $81.6 billion, up 85% year over year. Data center revenue came in at $75.2 billion, up 92% year over year. And on top of that, the company announced another $80 billion in buybacks. This is not a small number, and the message was very clear. AI infrastructure demand is still extremely strong. Now look, Nvidia being strong is not exactly a surprise anymore. Everyone knows Nvidia is one of the biggest winners of the AI boom. But this quarter mattered because the entire market is still leaning heavily on the AI story. If Nvidia had disappointed, that would not just have hurt Nvidia. It could have hit semiconductors, cloud infrastructure, networking, power equipment, data center names, and basically anything connected to AI capital spending. Instead, Nvidia gave the market another reason to believe the AI build-out is still real, but I would not just stop at the headline numbers. The business momentum is clearly impressive. The harder part is valuation and expectations. When a company becomes this important to the market, strong results are almost expected. So the real question is not, is Nvidia a great business? It obviously is. The question is whether future growth can continue to be strong enough to support the price investors are already paying. That is the part I would pay attention to, because when expectations get this high, the margin for error gets smaller. Now, the bullish AI story was one side of the week. The other side was inflation. The market was still dealing with April CPI, where headline inflation came in at 3.8% year over year, up from 3.3% in March. Core CPI was 2.8%, and energy prices were up 17.9% over the year. That is not the kind of inflation backdrop investors want to see when they are hoping for rate cuts. And the Fed commentary did not exactly calm people down. The latest Fed minutes showed policymakers were getting more worried about inflation risks, especially with energy prices and geopolitical tensions in the background. There was also commentary suggesting the Fed should stop signaling future cuts if inflation remains persistent. That changes the tone. It does not mean a rate hike is guaranteed. That would be too strong. But it does mean investors cannot just assume the next move is definitely a cut. The Fed seems to be moving back toward a more two-sided setup. Maybe they hold, maybe they cut later, but if inflation does not cooperate, they may have to stay restrictive for longer. And that matters a lot for stock picking. In a low-rate environment, the market tends to be more forgiving. Companies can trade on stories, future growth, and long-term potential. But when rates stay higher, investors start caring a lot more about earnings quality, cash flow, margins, balance sheets, and pricing power. That is where this market gets more selective, and we saw that clearly in retail earnings. Target actually reported a solid quarter on the surface. Net sales grew 6.7% year-over-year. Comparable traffic rose 4.4%, digital comparable sales increased 8.9%, adjusted earnings came in at $1.71 per share. Those numbers do not look bad at all, but the stock still dropped more than 7% after the report. Why? Because investors were not just looking at sales growth, they were looking at the quality of that growth. If a retailer needs price cuts and higher investment spending to drive sales, margins can come under pressure. So even though the headline numbers look decent, the market was asking whether the earnings power is really improving. I understand that reaction. Retail is not just about getting people into the store, it is about doing that profitably. Then you had Home Depot and Lowe's, which gave us another angle on the consumer. Home Depot reported net earnings of $3.3 billion, or $3.30 per diluted share. Adjusted earnings were $3.43 per share, and management reaffirmed guidance. Lowe's reported revenue of $23.08 billion and adjusted earnings of $3.03 per share, also beating expectations and reaffirming guidance. So home improvement is not falling apart, but it is not exactly booming either. The issue is big-ticket spending. When mortgage rates are high, housing turnover is weak, and consumers are still dealing with inflation, people become more careful about expensive home projects. They may still spend on repairs or necessities, but major discretionary renovations, that is a tougher sell. Then Ross Stores came in with a much stronger retail signal. Earnings were $2.02 per share. Revenue was $6.01 billion. Comparable sales grew 17%, and the stock jumped more than 6%. That is a very different message. It suggests consumers are still spending, but they are looking for value off price. Retail works well in that environment because shoppers want deals, so the consumer is not dead, but the consumer is more selective, and for investors, that difference matters. Now, one of the most interesting developments this week was not an earnings report at all. It was the NextEra and Dominion deal. NextEra announced it would acquire Dominion Energy in an all-stock deal. Dominion shareholders would receive 0.8138 NextEra shares for each Dominion share, plus continued dividends through closing and a one-time $360 million cash payment distributed across Dominion shares. Reuters described it as a $66.8 billion US power deal, and this is where the AI story starts to get broader, because AI is not just about chips anymore. It is not just Nvidia, AMD cloud providers, or data centers. The AI build-out needs electricity, a lot of electricity, and that means power generation, grid capacity, gas infrastructure, nuclear cooling, and industrial infrastructure may all become more important. That deal is a signal. The obvious AI winners are already well known, but the second-order beneficiaries may be where investors start looking next. Now, that does not mean every utility or power-related stock is automatically a great investment. Valuation still matters, debt still matters, regulation still matters, but the theme itself is worth taking seriously. Commodities also played a big role this week. Oil was probably the most important one. Earlier in the week, rising crude prices fed inflation fears and pushed yields higher. Later in the week, optimism around a possible US-Iran framework helped ease oil and yield pressure, which gave stocks some relief. Gold was interesting too. You might expect gold to do well when there is geopolitical uncertainty, but it struggled and was heading for a second weekly loss. The reason is that higher yields and a firmer dollar can make gold less attractive. That is a good reminder. Gold does not automatically go up just because the world feels uncertain. Rates still matter. Bitcoin traded higher into the weekend, near $76,782, up 1.68% on the latest reading. That fits with the improvement in risk appetite late in the week. But crypto is still very sensitive to liquidity and rate expectations, so if inflation surprises the wrong way, that can quickly change. So when I zoom out, I think there were 5 main themes from this week. First, AI demand is still the strongest bull case in the market. Nvidia's quarter made that very clear. Second, inflation risk is back in focus. CPI, PMI price pressures, oil, and hawkish Fed commentary all point in the same direction. Third, power infrastructure is becoming part of the AI trade. The NextEra Dominion deal made that theme harder to ignore. Fourth, the consumer is still spending, but they are spending more carefully. Target, Home Depot, Lowe's, and Ross all show different versions of that same idea. And fifth, higher for longer creates a quality filter. Companies with strong margins, pricing power, clean balance sheets, and real cash flow are in a much better position than companies that need easy money to keep the story alive. Looking ahead, the biggest event next week is April PCE inflation on May 28th. That is the Fed's preferred inflation measure, so it can absolutely move markets. If PCE confirms sticky inflation, investors may have to rethink rate expectations again. If it comes in cooler, the market could get some breathing room. We also get the second estimate of first quarter GDP and corporate profits, plus April new residential sales. Housing will be especially important because it is one of the clearest places where higher rates show up in the real economy. On the earnings side, Marvell, Dell, Costco, and Snowflake are the names to watch. Marvell and Dell matter for AI infrastructure. Costco gives us another read on the consumer. Snowflake matters for enterprise software and data cloud demand. So what did we learn this week? I think the bull case is still alive. In some areas, it actually got stronger. Nvidia's numbers made it hard to argue that AI demand is slowing in a major way, and the power infrastructure theme looks more important than ever. But the market is also more fragile than the index levels suggest. Inflation is not gone. Rates still matter. Oil still matters. And the Fed is not rushing to rescue the market. So for long-term investors, I would focus less on chasing every short-term move and more on finding businesses with durable demand, strong balance sheets, pricing power, and the ability to turn growth into real cash flow. AI is still the dominant market theme, but the opportunity may not only be in the obvious names anymore. The market can keep climbing if earnings stay strong and inflation cools. But if inflation data surprises the wrong way, this can quickly become a much more selective environment. That is the balance I would keep in mind. Strong bull case, real risks, bigger rewards for being selective. If you found this breakdown helpful, make sure to like the video, subscribe to the channel, and comment below what you're watching most closely next week. Nvidia and AI, inflation and the Fed, or the next wave of power infrastructure stocks.